All right, we are back today. This is a very key lecture, so I'm glad you are here today, okay? This is a very, very important lecture. Has anybody here had accounting before in high school or college? Anybody? Okay. Then you'll understand. This is the lecture where we're going to introduce the concept of debits and credits and those sort of things. And this is such an important lecture for you folks at home, you might even want to watch this one twice, okay? And if you all have trouble with it, you might want to watch it again online or whatever as well. So these things are available to you as well, okay? The first thing that we're going to do, though, is go over the homework that I assigned, all right? And I know I assigned the Valentine financial statements, correct? So how did those go for you? I think I gave you check figures on those, didn't I? Did those check figures come out all right? Okay. Let's take a look at that real quick before we move on to new material, all right? Let's take a look. We know the income statement is the first one we have to prepare. Whoops, wrong way. Okay. So take a look at that. And that's the balance sheet. Huh. Never mind. Sorry, guys. We'll edit that all out. All right. Let's take a look at the income statement. Okay. There is the income statement. Okay. We know the income statement is the first one we have to prepare, correct? Notice that I headed this up correctly with the name of the company, the name of the statement, and for the month ended. Make sure you do that. Don't get lazy and not do that or get in the habit of neglecting that. Okay? Couple things I want to point out on financial statements. I may have pointed some of these out, but that's okay. It's worth repeating. Number one, never leave a number just hanging there. Like if you just had net income or just had this number down here without a title over here, you don't want to do that. You don't want to have numbers without labels on them, okay? So make sure you put net income there, okay? The other question somebody asked me once is, what if I didn't itemize these out, but I just had total expenses, $1160? Did anybody do that? Okay? I don't want you to do that. I want you to itemize them out because that gives the reader of the financial statements a lot more information. And remember, the primary objective of financial accounting is to provide financial statements for the users to make better decisions. So if we just told them what the total expenses were, it wouldn't give them as much information. Okay? So itemize those things out and make sure you label everything. What's the next statement that we prepare after the income statement? Statement of equity. Statement of equity. And that is right below here. And you can see that net income that we calculated above drops down to the statement of equity. Excuse me. Okay. You can see where I headed it up correctly and properly, the name of the company, the name of the financial statement, and I dated it properly. Actually, I forgot to change this one. That's actually 09, isn't it? Not 07. Okay. Now here is an example where the beginning capital is not 0. Remember how I talked last class period as far as don't be thinking that the beginning balance of capital on the statement of equity is always 0. It seems like that's all the examples in the book are like that. Okay? Most of the time it won't be. The only reason it was in the book like that was because that was their first month of operations. Okay? All right, any questions on the statement of income or the statement of equity? Did you guys get this pretty much? Also notice that before we leave these two, unearned revenue is not listed up here, correct? Did anybody accidentally list it up there? That's a common mistake. And if you do that, the balance sheet will still balance in the very end, even though it's wrong. So remember, unearned revenue is a liability, not a revenue. Okay? Well, what is our balance of capital at 8/31/09? It's 31,540. And when we go over to the balance sheet, there it is right there, 31,540. Okay? Okay? Once again, make sure first of all that you total these things up. Don't just list these out, but put the total, and then also make sure you label it, okay? Because the reader of the financial statements wants to see that these two numbers equal, okay? And they want to know what those numbers are, so be sure to label those, okay? And there's our unearned revenue in the liability section where it's supposed to be, okay? And there's the capital, that came from the statement of equity. And it is dated properly, right? Don't say for the month ended 8/31/09. Just say 8/31/09 or as of 8/31/09. Okay? Now, if you do that wrong on the test, I'll lovingly take a point off because it really is important that we learn the proper way to date these things. Okay? Any questions on Valentine? Hopefully you folks at home did well on that as well. Make sure you're doing all these exercises, even though I can't tell if you are. But be disciplined and make sure you do all this. Okay? No questions on Valentine? Okay, if not, let's jump over to exercise 1.5. Now, this is probably one I should have assigned a few periods ago, but that's okay. It'll be a good refresher. This is in regards to the different forms of business that we could have: a sole proprietorship, a partnership, or a corporation. And what it asks us is, it tells us several descriptions of some different business organizations, and it wants us to determine whether it's a sole proprietorship, a partnership, or a corporation. You with me? Okay, exercise 1.5, page 30 in your book. A, Wallingford is owned by Gary Malone, who's personally liable for the company's debts. What is that? Sole proprietorship. There's one owner. He's personally liable. B, Ava Fong and Elijah Logan own financial services, a financial services provider. Neither Fong nor Logan has personal responsibility for the debts of financial services. Corporation, because there's limited liability. C, IBC Services does not have separate legal existence apart from the one person who owns it. Sole proprietorship. D, Computing Services pays its own income taxes and has two owners. What is that? It has two owners, but it pays its own income tax. So it's a corporation, okay? It's a corporation because the company pays its own. Certainly a corporation can have just two owners, even though we're kind of trained to think of corporations as thousands of owners, okay? So D is a corporation because Computing Services pays its own taxes. E, ownership of Zander Company is divided into 1,000 shares of stock. Corporation, right? F, Emma Bailey and Dylan Kay own Speedy Packages, a courier service. Both are personally liable for the debts of the business. Partnership. There's two of them, and they're liable. There's unlimited liability. And G, Physio Products does not pay income taxes and has one owner. Sole proprietorship. All right? Questions on that? Okay. I'd like you guys to know those. That's a good one for maybe a multiple choice type question or two on the test. Okay? All right. Let's jump over to exercise 118. And I believe, correct me if I'm wrong, class, once we go through 118, that's the last one I've assigned from chapter 1, correct? So this is our official ending of chapter 1 after we get through exercise 118. And what exercise 118 is talking about is the return on assets, okay? Now, you'll notice that the way this book goes is that at the end of each chapter, it gives you a ratio, okay, to learn about. And in this particular case, it is a return on assets. Now, just like there are, you guys play baseball, is that right? Okay. There are many statistics and ratios in baseball, correct? ERA, batting average, slugging percentage, on-base percentages, all those different things, right? Now, those are tools for your coach to manage your team, to know if you're improving individually, or to compare you to other individuals, right? And he probably compares your team averages to other team averages in the same conference as you, right? Now, those measurements or statistics or ratios, they are tools. They are tools. And they need to be used in conjunction with other things as well, right? For instance, you wouldn't just say that if one player has a 320 batting average and another player has a 300 batting average, that you know for sure the 320 is the one you want. You don't know that for sure, right? Because that's only one measurement. You don't know what time period that's involved or anything, okay? So these are tools. These are not the end objective. These are tools in evaluating businesses, okay? Now, when we learn these ratios and measurements for businesses, we have to make sure we compare them to reasonable other companies. For instance, I would not want to figure out the ROA on a legal firm and compare that with the ROA of a steel manufacturer. That doesn't make any sense. That would be like comparing the hitting average for a pitcher against the hitting average for a first baseman. That doesn't, you see what I'm saying? It's kind of two different things, right? Or another, the example that I always use is football, okay? You cannot just look at a measurement or a ratio and know, is this good or bad? For instance, if I told you a football player ran a 40-meter in 4.7, is that good or bad? Well, I don't know. If it's a running back, that might be a little slow, right? Or a wide receiver or cornerback. What if that's an offensive lineman? It's pretty doggone. That's trucking, isn't it? Do you see what I'm saying? So you have to be, and you certainly wouldn't compare the 40-meter dash speed of an offensive lineman with the 40-meter dash time of a cornerback, would you? That doesn't make any sense. That would be like evaluating the ROA of a steel manufacturer with the ROA of a legal firm, okay? So we want to make sure that we do reasonable comparisons. Comparisons with similar firms in the same industry, or comparisons with the same firm but at different time periods, right? Just like they might look at your batting percentage, Gil, for the last 5 games and compare it to the batting average for the previous 5 games, compared to your batting average for last year, okay, to see if you're improving over time. Okay, that's a reasonable comparison, right? Does this make sense? So these statistics and these ratios, just like in sports, have to be used properly for them to be helpful, okay? Now, return on assets is the first one that they introduced to us. And return on assets is net income divided by average total assets, okay? Let's take a look at 118. Iowa Group reports net income of $36,000 for 2009. At the beginning of 2009, Iowa Group had $135,000 in assets. By the end of 2009, assets had grown to $185,000, okay? Thus, what is the average assets for this company? What's 135 plus 185 divided by 2? 160, isn't it? Okay. The average operating assets, add the beginning to the end, divided by 2. And in this case, I believe it is 160. What is Iowa Group's 2009 return on assets? How would you assess its performance if competitors average a 10% return on assets? So they're telling you a competitor that's going to be in the same industry, obviously, so that would be a reasonable comparison. Okay? All right, so how do we calculate that? Right there in the middle. We take net income divided by average total assets, okay? and we get 22.5% ROA for Iowa Group. Did you guys get that calculation? Now, there are ways that you can punch this into your calculator that's going to give you a wrong answer. For instance, if you went 36,000 divided by 135,000 plus 185,000 divided by 2, that would give you probably an incorrect answer. You need to make sure that in the parentheses, think back to your math class, that this average is calculated first, and it's 160, and then take 36,000 divided by it. Does this make sense? So when you punch in your calculator, don't be careless as far as the order of operations. The answer for this ROA is 22.5%. Its competitors have a 10% ROA. Hey, looks pretty good to me, doesn't it? So you could compare this to its competitors, or you could compare it to previous periods' ROAs. Okay? And that would be one tool you could utilize in assessing the health of this company. All right? Okay? All right. Any questions on ROA? Okay? I usually ask like just one multiple choice question on a test about the ratios. Okay? I want to focus on them a little bit, but I don't want to just hammer on them. Okay? I don't want to hammer on them. Okay? We are done with chapter 1, my friends. Now, chapter 1 might have felt like it took a while. As I said, the way that I teach this class is I spend a little bit more time on chapters 1 and 2 because I think it important to make sure that we have a solid foundation of which to build the rest of the class on. Okay? Some of you might have even thought, gosh, we're moving a little slow. Well, that's okay. Don't worry about it. I just want to make sure we get as many people on the bus as we can. Okay? We're going to speed up a little bit. But we don't have enough class periods for me to spend this much time on every chapter. You with me? What we're going to do today is start on chapter 2, a very, very key lecture. Okay? Now, let's go over to the PowerPoints. Does everybody have the PowerPoint here in this class physically? Everybody has this? For you folks at home, I email these PowerPoints to you. Okay? So it's very helpful, I think, to have these as we go through the lecture, but I always email these to you. Okay? All right. Chapter 2, Analyzing and Recording Transactions. We're going to lay a little groundwork here before we get to the main topic. The first thing that we're going to talk about is that there are a number of different transactions that occur within a business, right? You get a loan from a bank. You sell something to a customer. You pay your employees. You buy some office supplies. Someone pays on their receivable. You pay some of your debt off. Those are all transactions. Now, some of those are external transactions. They occur between the company and an outside party. And some of those are internal transactions. They occur within the company. There's no external party. Okay? So recognize that. The next thing I want to focus on is to get our old buddy, the accounting equation, correct? Once again, another reminder. Assets equals liabilities plus owner's equity. Another way of saying that is if you figure up the ending balance for all your assets account and add them together, they will equal the sum of all the liability accounts and all the equity accounts. Okay? Assets always equals liabilities plus owner's equity. A review on some of our asset accounts, and I think we have talked about all of these except for perhaps prepaid accounts. We haven't addressed that one, have we? Prepaid accounts would be things like, let's say that I paid paid my landlord for the next 6 months worth of rent for the factory building or for the office building that my business has. So I've prepaid the next 6 months of rent. That is an asset, all right? A prepaid asset in your own life is usually car insurance. A lot of times you'll pay for your car insurance for the next 6 months ahead of you right then at the beginning. And that is a prepaid asset. That's called prepaid insurance. So we can have prepaid rent, prepaid insurance, prepaid advertising. Anything prepaid is an asset. Okay? We talked about liability accounts. And I think we've addressed all of these before, except with maybe an exception or two. Once again, unearned revenue is a liability account, isn't it? Goes with the liabilities. What about accrued liabilities? What is accrued liabilities? Well, we're going to talk more about that in Chapter 3. But accrued liabilities is kind of a broad term that encompasses a lot of different types of payables, such as wages payable or salaries payable if we have money that is owed to our employees, or income taxes payable, or interest payable. Okay? Those are examples of accrued liabilities. Usually we don't have an account called accrued liabilities. Usually that is just a broad term to describe accounts that fall under it. Okay? We have our equity accounts, and we talked about what sort of things increase owner's capital or equity and what sort of things decrease it, right? So we've talked about that. And we talked about thus the expanding accounting equation, recognizing the things that decrease equity and the things that increase equity, right? This is all just kind of a refresher. Okay, I want to show you a slide now that is going to encompass a lot of terms that we don't even know yet. And when we go through this slide, you might think, what the heck was all that about? That's understandable. We're going to address this slide once again at the end of the chapter, and I think it will make more sense. But I want to give you a little map as far as where we're going. Okay? So going over to that slide, we are going to analyze transactions in accounting using what we call source documents. Now, what is a source document, and how do those help us analyze transactions? Well, source documents are those pieces of paper or emails or something like that that result from different transactions that might occur in business. For example, if you went and bought a computer at Best Buy after class, they would probably give you a receipt. They would give you an invoice, right? If you wrote a check for that computer, you would eventually get a bank statement, and you could see where that came out of your account. They might even have a little photocopy of the little check that you wrote to Best Buy. That's a source document. Okay? All these different pieces of paper that are generated in our lives by transactions occurring. When you get paid where you work, don't they usually give you a check, and then they give you a check stub that you can keep for your records? Correct? If you go and pay a parking ticket, they'll probably give you a receipt that shows proof that you paid that, correct? These are source documents. They're very important to accounting. They provide a trail for us to validate the transactions that we've recorded, okay? So we analyze transactions from source documents. We're going to find that we record these transactions in something called a journal. And we'll talk in this chapter about what a journal is. Eventually, we will post the journal information to what we call ledger accounts, and then we will prepare and analyze what we call a trial balance. Again, we haven't defined these terms, so don't wig out if those don't make perfect sense now. Okay, what I want to talk about is, what is an account? An account records all the increases and decreases in a specific asset, liability, equity, revenue, or expense item. And we have used accounts. For example, going over to the Elmo, like if we had, let's say that we had cash. Remember how we did this in chapter 1? And we might say plus 3,000 minus 500 minus 300 plus 400 plus 100, right? We're recording those increases and decreases in that account, right? Okay? That is an account for cash. And of course, we can figure out what the ending balance is for that account, can't we? And in this case, let's see what it is. 3,500, 2,700? Okay, that is the account balance. Okay? Now, we will come back to that guy in a second. But let's also define the other term that they give us. The general ledger is a record containing all the accounts used by the company, and thus their increases and decreases. If you look at your answer on exercise 112, that is a good example of a general ledger at this at least elementary stage. Because it has a lot of different accounts at the top, and it shows the changes, the increases and decreases that are occurring, and then it shows their balance at the end, right? Okay? Make sense? All right. Now, I want to learn a new way of recording business transactions. Okay? This is going to be a transformation from the old chapter 1 way to the new chapter 2 and beyond way. Okay? And this is a key change we're going to make. What I often describe it as, it's like chapter 1 is like your training wheels on your bike. Okay? Now, most of you probably know how to ride a bike, right? A lot of you probably learned how to ride a bike using training wheels, correct? Now, that wasn't going to be the way. That's not your ultimate objective, right? But the training wheels give you a feel for how riding a bike should feel physically in your muscles and all that sort of stuff. It teaches you balance, but it's not the ultimate objective, is it? And one day, Dad comes out with a crescent wrench and takes the training wheels off the bike, right? And then you learn how to ride a bike. And that's how you ride it from then on, right? Do you ever go back to the training wheels? Do you ever think, you know, I'm going to take a bike ride tonight, but I think, just for old time's sake, put those training wheels back on, okay? You don't do that. So when we move beyond this chapter 1 method and learn the new way of doing this, we'll never go back to the chapter 1 method. It wasn't a waste of time. It helped us as a stair step from where we were to where we want to be. Correct? So it's time for me. I'm Dad. I got my crescent wrench. Time to take off the training wheels. Okay? Let's go back to the Elmo. All right. You guys understood what I did here, correct? I have cash, and I have the increases and some decreases listed there, and I have the account balance, right? What if instead of writing it like that, what if I wrote it like this? And I just decided to put the increases together on the left side. Whoops, we have 400 first, don't we? And the decreases over here. Okay? You see, pretty much the same thing, right? I just decided to put the increases over on the left side and the decreases on the right side, okay? And the balance of here, it would still be 2,700, correct? Make sense? Okay. And what I actually might do is just to separate this, I might put a line down the middle there, okay? So you with me going from here to here? Everybody still with me? Okay, now what if, since I know that for cash, the increases are on the left side and the decreases are on the right side, what if I change this just a little bit and got rid of the plus and minus signs, and I just said, okay, let's just we know these are increases, so I'll put those there. And the balance is still 2,700, correct? Now, do you see the transition from here to here? Okay? Well, for those of you who had accounting, you know that what we have created is called what? The T account. The T account. Looking back at the Elmo, why do we call it a T account? Because this kind of looks like a T, doesn't it? The T account is a mechanism we use to keep track of an account's increases and decreases. Okay? Now, for a T account, the left side of the T account is called the debit side, and the right side of a T account is called the credit side. Are you with me? The way we abbreviate debit is it is actually abbreviated DR. And don't ask me why it's abbreviated DR, because I know there's no R in there. And the way we abbreviate credit is CR. Okay? So once again, we went from chapter one way, then we did change that to this, and then we changed that to this. Okay? Now I have just introduced two terms to you that we have not yet discussed before. Those terms being debit and credit. All right. The way that your brains work, the way that everybody's brains work, is that when you learn a new concept, your brain goes out in itself, tries to find something that you do understand, and kind of bridge it together. Does that make sense? So what some of your brains did when you heard the words debit and credit is you went through a thought pattern that I want to caution you against going through. Let me talk about that. Regarding debits and credits, do not think of the way others use these terms, such as your bank. No, 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 no. I want you to think that debit is synonymous with the left side and credit is synonymous with right side. Are you with me? Do not think of the way your bank talks about when they debit your cash or they credit your cash account. Get that out of your brain. It's going to confuse you. Do not think of like your debit card or your credit cards, those little plastic cards that you have in your wallet. Don't be thinking that. Don't let your brain go down there. Debit simply means the left side. Credit simply means the right side. Are you with me? Debit means left. Credit means right. You with me? Don't think of debit as debt and credit as credit like the world defines them. Nope. Don't do that either. Debit is not debt. Credit's not credit like if you get credit, you know, by a teacher or credit on your credit card or something. Nope, 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 nope. Debit means left. Credit means right side. Do not mistakenly think of debits as good things and credits as bad things. No, no, no. Debit means left side. Credit means right side. Okay? It would have made my life easier as an accountant if they actually would not have originated the whole thing with the words debit and credit. I wish they would have called it lefty and righty. Okay? Because these terms confuse people. Debit means left, credit means right. Okay? The next slide is very important. Debit means the left side. Credit means the right side. Are you with me? Okay? I know I'm pounding this in. Now, if you go back to the Elmo and you look at this T account, by golly, Dave is right. Debit is the left side, credit is the right side. Now listen to me, this is important. You might understandably, but mistakenly, when looking at the specific cash account, think that debit means increase and credit means decrease. I can see why you'd see that. But debit does not mean increase. Credit does not mean decrease. Debit means the left side. Credit means the right side. Yes. For cash, it just so happens that increases are on the debit side and decreases are on the credit side. But that is not the case with every account. Okay? It is for cash, but not for every account. For instance, let me show you a new account here. Let's say, for instance, notes payable. That's a debt. That's a liability, right? Notes payable. Now, for notes payable, this is the T account. What is the left side called, and what's the right side called? Debit. And I'm going to use the abbreviations. And credit. It doesn't matter the T account. The left side's always the debit side. The right side's always the credit side. Now, yes, I was correct in saying that cash, the increases are on the debit side, the decreases are on the credit side. But for some accounts, such as note payable, it's the opposite. Increases are on the credit side. You with me? For some accounts, increases are shown on the credit side. Okay? For some, it's on the debit. Okay? Now, I know you have some questions here. Hold off if you could, because I'm probably going to get to where you're wondering. Okay? A couple of things I want to say as well. When I wrote that 500 in the credit column, that is called crediting the account. When you write a number on the right side or the credit side of a T account, that is called crediting an account. Okay? If you write something on the right side of a T account, that is called, if you write something on the left side of a T account, that is called debiting the account. You with me? So when I wrote that 3,000 there, I am debiting cash for 3,000. When I wrote that 500 for cash, I am crediting cash for 500. Are you with me? Another thing, no matter the T account, opposite sides of the line have opposite effects. Thus, if this is an increase, then this is a decrease. Or for notes payable, if this is an increase, then this is a decrease. Are you with me? I know I'm throwing out a lot of information to you, but it's vital. It's vital. Okay? I know some of the questions you have. Hang on there. Let's go back to the Elmo. Debit means left, credit means right. Now, we call an account that increases when you debit it a debit balance account. Cash is what we call a debit balance account. Thus, that means that's how you increase it. You debit it. For a debit balance account, increases are kept track of on the debit side and decreases are on, thus, the credit side. Cash is a debit balance account. Are you with me? An account is called a credit balance account if that's the way you increase it. Thus, if you increase it with a credit, it is a credit balance account, and thus a debit decreases it. You with me? Now keep in mind, though, that all accounts are both debited and credited at times. Don't think that debit balance accounts are only debited and credit balances are only credited. All accounts are both debited and credited. The key is to know for a specific account how it is increased and how it is decreased. If it is increased with a debit, then it is a debit balance account, and it is thus decreased with a credit. If it is a credit balance account, then it is increased with a credit and decreased with a debit. Does that make sense? Let's say, using those two accounts we've talked about, and going back to the Elmo, let's say that you got a loan from a bank for $1,200, okay? So your cash goes up by $1,200, right? And your notes payable goes up by $1,200, correct? That's the Chapter 1 way. Well, how would we show those in the T account? Well, we do a T account for cash, and we do a T account for notes payable. For both T accounts, the left side is the debit side, the right side is the credit side. And like I told you, for cash, increases are on the debit side. It is a debit balance account. Thus, I would put $1,200 here. I would debit that account for $1,200 to show that. For notes payable, it is a credit balance account. Thus, that's where you show the increases, on the credit side. And I would thus put the $1,200 right there. Does this make sense? Okay. All right. So the key question here is here, coming off the Elmo, coming on to me live. The key question is, okay, Dave, you told us that cash was a debit balance account and thus increased with the debits and decreased with credits. You told us that notes payable, though, was a credit balance account. Thus, the increases are shown on the credit side and the decreases on the debit side, right? Don't you think the key question is, well, which accounts are debit balance accounts and increase with debits, and which accounts are credit balance accounts and thus increase with credits? Don't you think that's the key question? Well, that is the key question. And if you turn in your blue book, the blue student manual with the piggy bank on the front, to like the second page, I give you a very, very important page. And what I do is I list out a bunch of accounts, and I tell you whether they are debit balance accounts or credit balance accounts or whatever. And sure enough, if you look at cash, cash is a debit balance account, thus it increases with a debit. And notes payable down there is a credit balance account, thus it increases with a credit. You with me? This is your guide to which accounts are debit balance accounts and which accounts are credit balance accounts. Remember, if I say it is a debit balance account, that means that's how you increase it, with debits. And credits would thus be decreases. If I say something's a credit balance account, like notes payable, you increase it with a credit, you decrease it with a debit. You with me? Now let me tell you the way to learn these, and then let me first tell you the way to not learn these. Don't get a piece of paper and go, okay, let's see. Cash is a debit balance account. Good, I got that one. What's AR? What's accounts receivable? I think it's debit too. Oh, good, I'm dead on, baby. What about inventory? No, don't do that because I have them all grouped together. What is the best way, even in these technological times of computers and the internet, what is the best way to learn your account balances? Flashcards. Still the best way. And when I say learning your account balances, what I'm saying is, what's the best way to learn if an account, which accounts are debit balance accounts and which accounts are credit balance accounts? Here's the way you do it. Get a flashcard, index card, or whatever. This is the front of the card. This is the back of the card. On the front of the card, for each of those accounts on that sheet, on the front, write what the account is. And on the back of it, say, is a debit balance account. And you might even expand that a little bit in this and say, therefore, a debit increases, a credit decreases. And if you even want to go above and beyond, you could even write down here what financial statement it shows up on. That is the way that you learn these balances. For each one of these accounts, prepare its own flashcard. And then mix them up. And when you're walking on campus, or you're waiting in a doctor's office, or it's a commercial in a football game, go through those and learn them. You can laminate them. And when you take a shower, you can look at them. I'm kidding about that. But trust me in this. The quicker and better you learn your account balances, the quicker and better and more efficient you'll be, and the easier this class will be. Okay? Now, I am well aware that there's certain little lingos and little rhymes and all that sort of stuff to help you learn your balances. I'm not a huge fan of those. I am more so a fan of being able to look at a balance and boom, you know if it's a debit balance account or a credit balance account. Are you with me? You need to know it right away. If you don't get this, this class will be impossible. By the way, is anybody here taking calculus? Lauren is taking calculus. Okay, Lauren, I'm going to give you a quick little quiz. Okay? I want you to fill in this blank. What number goes in that blank?
I'm going to go with 5.
You are correct. Now let me ask you this. If I would have asked Lauren that question, and he would have said, going back to the Elmo, what if he thought the answer 3? What if he honestly thought 3 belonged in that blank? Let me ask you this, Gil. How well do you think Lauren's going to do in his calculus class? Very poor. What if he said -7 or pi or 1776 or Abraham Lincoln, right? Any of those answers is the wrong answer. And I don't need to know. If you gave me and you honestly thought one of these wrong answers was what goes in that blank, I don't need to know anything more about you, Lauren. You're going to do very poorly in calculus. Okay? As a matter of fact, what if I asked Lauren what went in that blank and he had to put his head down and think about it for 30 or 40 seconds, and then he told us the answer, and it was right. If he has to think 30 or 40 seconds about what goes in that blank, he's not going to do very well in calculus, correct? When you learn these account balances, you want to know them. Boom. You don't want to have to go through some little rhyme or some little thing on your fingers. No, just know it. When I say notes payable, you say it's a credit balance account. Thus, it increases with credit, it decreases with debit. When I say cash, that's a debit balance account. Thus, it increases with a debit, it decreases with a credit. If I asked you your middle name, Zach, you'd know it right away, right? You wouldn't have to think about it for 20 seconds. In this class, when we work together, if it's chapter 4 or 5, and I ask somebody, okay, Lucas, cash is a debit or credit balance account. And if Lucas doesn't know what it is or he has to think about it, you can rest assured you're probably not doing as good in this class as you need to. I've taught this class many times. The way you do well in this class, the way you make it easier for you, is to make these flashcards, to learn them, to live them, to love them, okay? Learn your account balance. Have I emphasized that enough, guys? How many people are going to do your flashcards, okay? The difference is not between those who want to and those who don't. The difference is between those who do it right away versus those who, well, someday I'm going to make flashcards. Right after this class, make your flashcards, okay? Real quick, let me give you your homework, and I'll send you on your way, but the next lecture is very important as well, okay? What I want you to do for homework, besides making your flashcards, is I want you to do quick study. 2-2, that will be review. 2-3, 2-4, and 2-5. That's it, guys. Do your homework. Lauren, you have a question?
Yes. Are these the only accounts we're going to have to know?
No. That's a great question. Notice how I listed some blanks there. As you learn new accounts in this class, hold on a second. As you learn new accounts in this class, write them in there, or better yet, just make a flashcard for them. Good question. All right. We'll see you guys later. Bye-bye.